Hey everyone, welcome back. It's February 2026, and there's a belief that still traps millions of people financially every year. The idea that keeping your money in a so called safe savings account is the smart, responsible, risk free thing to do. You hear it all the time: keep it safe, don't lose it, cash is king, banks are secure. It feels good to see the number not go down. But in 2026, this belief has become one of the biggest illusions in personal finance. What looks safe on the surface is quietly making people poorer, sometimes by thousands of dollars a year, while they think they're being cautious. Today, we're going to pull back the curtain on the illusion of safe savings, why it feels so right but costs so much, what the real risks are right now, how inflation and opportunity are the silent thieves, where the truly safe money actually lives in 2026, and the simple moves you can make this week to stop the slow bleed. Let's get into it. First, the illusion starts with the word safe. People think safe means my money won't disappear. No market crashes, no crypto wipeouts, no stock dips. And technically, that's true. If you put $10,000 in a savings account at Chase or Habib Bank or any big traditional bank, that exact $10,000 is still there tomorrow, next month, next year. FDIC or DICGC insured up to certain limits, no principal loss. But safety isn't just about principle. Safety is about purchasing power, and that's where the illusion cracks wide open. As of December 2025, the latest CPI inflation rate in the US was 2.7% year over year. In Pakistan, it's been running higher, around 7 to 9% depending on the basket you look at. Even if we take a conservative global average of 3 to 4% for many middle income countries in 2026, the math is brutal. A traditional savings account, whether it's 0.1% at a big bank or 0.5% at a slightly better one, is paying you almost nothing. Let's say 0.4% on average. On 100,000 rupees or dollars, that's 400 units of currency in interest for the whole year. Inflation at 3% means the same basket of goods that cost 100,000 last year now costs 103,000. Your money buys 3,000 less stuff. After interest, you're still down 2,600 in real terms every single year. Over 10 years, that compounds. 100,000 at 0.4% nominal grows to about 104,000 nominal. But at 3% average inflation, you need about 134,000 to buy the same things. You're 30,000 poorer in real purchasing power while feeling safe. That's the illusion. You didn't lose money, you lost what money can do. And most people never notice because the bank balance looks stable. Second part of the illusion: people think there's no better safe option. They say high yield accounts are risky or complicated or not available where they live. In 2026, that's simply not true anymore. High yield savings accounts are paying 4 to 5% APY in the US, Varo, Adelphi at 5%, Newtek at 4.35%, Openbank at 4.2%, all FDIC insured. In Pakistan, digital banks and fintechs like SadaPay, NayaPay, or certain Islamic banking options are offering 3 to 6% on savings pots, often with easy apps and no minimums. Globally, money market funds, short term government bonds, or treasury bills are yielding 3 to 4% with virtually no risk. These options are as safe as traditional savings, same government backed insurance or sovereign backing, but they actually keep up with or beat inflation. The difference is thousands of units of currency every year on a decent sized fund. Third illusion: cash is the ultimate protection against everything. People keep large amounts in cash because they fear stock crashes, job loss, or economic collapse. But cash protects against one risk: deflation, and loses badly against the bigger long term risk: inflation and opportunity cost. In 2026, we're seeing AI driven productivity gains pushing some prices down: tech, entertainment, education. But essentials like housing, energy for data centers, healthcare, and food are still rising. Inflation isn't disappearing, and missing out on growth assets compounds the damage. Money sitting at 0.4% for 10 years, while equities average 7 to 10% historically, means tens of thousands left on the table. So, what's the real safe place for money in 2026? For true emergencies, 3 to 6 months or 6 to 12 months if your income is volatile, keep it in high yield savings or money market accounts earning 4 to 5%. Liquid, insured, inflation resistant. For money you won't need for 1 to 5 years, house down payment, car, education, short term treasuries, laddered CDs, or short duration bond ETFs. Still very safe, slightly higher yields. For everything else, long term wealth, stocks, index funds, real assets. Not risky if time horizon is long and diversified. Quick reality checklist for 2026. 1. Check your current savings rate. If it's under 1%, you're in the illusion zone. 2. Calculate real loss. Multiply your balance by inflation minus your rate. How much did you lose last year? 3. Move emergency cash to high yield today. Takes 10 minutes online. 4. Separate true emergency money from long term savings so you don't mix them. 5. Remind yourself safe isn't zero volatility, it's preserving what your money can actually buy. The illusion of safe savings feels comforting, but comfort is expensive in 2026. Real safety is keeping up with inflation, beating it when you can, and giving your money a job that pays you instead of the bank. If this woke you up about where your cash is sitting, hit like, subscribe, and comment. What's your savings rate right now, and are you switching to high yield this week? I read everyone. Thanks for watching. Stop settling for the illusion. Make your money truly safe in 2026. See you next time.